Thanks, Heather. Good morning, everyone. It's great to have you all back again to our Roadshow. We run this annually and delighted to be back here in Sydney to share a couple more ideas with you. I'd like to thank everyone for their support in 2017, and it's great to be here early in 2018 to share some ideas with you as we all sort of kickstart the year. As Heather said, I'm going to talk about a couple of things today. I'm going to just give you a refresher for those who might have been here last year on our investment principles, which are really the principles that guide our investment decision-making at Morningstar. And then I'm going to turn, in the second sort of half of my presentation, if you like, to talking a bit about this topic, the art and science of maximizing investor returns. And the really key difference here, of course, is the focus on the investor. There's a very, very big difference between the returns that investment managers report and the returns ultimately that investors actually receive. And I wanted to just unpack that a little bit. Where do these returns come from? How do you generate them? And then, equally importantly, how do you actually keep them? So just starting off with our investment principles. So as I said, at Morningstar, we have a set of 7 investment principles. And these are really intended to guide our investment processes and our investment decision-making. They're there to ensure that we behave in a very consistent and rational manner, irrespective of the investment environment that we actually find ourselves in. At the very beginning of those is the principle of putting investors first. So Jack Bogle is very outspoken about the need for us to consider ourselves and think of ourselves as a fiduciary society. And I think that's relevant not only for investment managers, but for financial planners as well. There's this whole essence of being a fiduciary, which of course is somebody who's placed in a position of authority or a position of power with respect to the assets or property of somebody else. And I think accepting or understanding the importance of being a fiduciary is that you actually have to accept that your investors or the end client actually has the right to insist that their interests take precedence over our own business interests. And I think it's very difficult for many businesses to do. And one of the reasons why we like to keep this at the forefront of our minds when we think about investing clients' money. We need to always remember whose money it actually is. Secondly, we're independent-minded or contrarian. Some of the best investment opportunities actually eventuate through the ability to think and act differently to the crowd. As Warren Buffett says, you need to be fearful when others are greedy, and you need to be greedy when others are fearful. If you think about the structure of investment markets in general, they're very dominated by institutional investors. And institutional investors, by and large, are incentivized either on the basis of how well they do relative to other institutional investment managers or against an index or a benchmark. And that actually stands in the way of being able to assess whether investments are actually good value in an outright sense. Understanding the behavior of those institutions or what drives them, what their incentives are, is very important in terms of understanding where some of the best investment opportunities are actually available. And Daniel, I should say, is going to unpack that a little bit in his session. We invest for the long term. Again, Buffett is undoubtedly the best example of long-term investing. He's quoted as saying, if you can find a great business with great management, his best holding period is forever. And you actually see that in the way that he's managed Berkshire Hathaway. Many of the companies that they've actually acquired at Berkshire Hathaway, they've acquired them outright with the intention of never actually selling those businesses. He's been far more interested in earning the cash flows that those businesses have generated and just accumulating them into the wealth of Berkshire than he ever was about thinking about the opportunity to actually sell it next week or next month or next year. So the long term is really the only, it's the only investment horizon over which valuation-driven asset allocation works. That's how we think about investing money. Being valuation-driven. So Benjamin Graham is, he's the father, if you like, of value investing, and he wrote the book on it quite literally. And what he says in that, or what he I think differentiated and distinguished quite eloquently, is just the difference between prices of securities, which, as we all know, very, very volatile. They move around quite dramatically every day, and they're very driven by demand, by buyers and sellers every day in the market. And what he really demonstrated was that through careful analysis and actually looking at underlying cash flows that companies generate, you could actually understand what an intrinsic value of a company was, a far more stable measure of value. And of course, really the essence of being a value investor is looking to buy securities when their prices are actually dramatically below the level of those intrinsic values, or what he called the margin of safety. And really what he was trying to do there was buy $1 but only have to pay 50 cents for it. So we're valuation driven. We take a fundamental approach. If you're a fundamental investor, what you think about when you invest is the cash flows, or the fundamental reason that you actually acquire an asset. If you're a fundamental investor in equities, what you're interested in mostly is the dividends that come back to you as a shareholder of that company. Those are the cash flows you earn. If you're a fundamental investor in bonds, it's the coupons that you get from the company as well as your capital back at maturity. If you're a fundamental investor in property, you're concerned about rental income streams and having that as a source of income or a source of cash flow from your investment. So thinking about those cash flows is really what drives the way we think about investing client money. Striving to minimize costs, I think that's pretty self-evident. The less that you pay to the purveyors of investment services, the more there is for your end investor. And costs take their form not only in explicit investment management costs, but through excess turnover or poor implementation, tax, incurring taxation where you don't have to. Tax is arguably the biggest cost that you might actually find in your investment. So having that again at the forefront of what we do is very important when we think about investing money. And finally, building portfolios holistically. And when you construct a multi-asset portfolio, you really do start with, everybody starts this way. You have equities in your portfolio as your return source and bonds for your diversification. Generally, those two assets have performed differently depending on the economic environment. In times when equities have performed very, very poorly, bonds have traditionally performed quite well. So when you think about adding another asset into a portfolio, you really want it to be behaving differently to either the equities or the bonds that you already have in your portfolio. Trying to find assets that have different return streams, behave differently in different market environments, is really what Ray Dalio referred to as the holy grail of investing. And that's really where we try and ensure that the whole portfolio is really worth more than the sum of its parts. So those are our investment principles. They guide our investment decision making, as I said. When we think about investing money on behalf of your clients, these are really the things that are at the forefront of our minds. So I wanted to just shift now, change gears a little bit and talk about this topic of investor returns. What I wanted to talk about is how we generate them and then some of the factors or impediments really that tend to erode them over time if we don't pay attention to them. Philip Stroll is our head of capital markets and asset allocation. He's based in Chicago, works with Daniel there. And he and Roger Ibbotson actually wrote this paper in Q3 of last year. So it's available for download on our website. It was published in the Financial Analyst Journal of the CFA Institute. And what they really sought to understand in that article was what are the long-term drivers of stock market returns. And really, as I've got there in the quote, what they actually concluded was that in the short term, returns are very driven by demand. But in the long run, it's actually the cash flows that corporations supply that determine or that are the ultimate drivers of stock returns. I'm going to show that here. So this is a chart that shows US large cap equities. This is a 145-year period. So we go back here from 1871 to 2015. And all it shows you is the return, the nominal return of US equities over that long, long period of time. And the nominal return it's about 9%. And if you actually look at where that return actually comes from, you can actually decompose that into its underlying building blocks. And the first one, of course, is inflation. So what's actually happened with inflation over that period of time? And that accounts for a little over 2% of that overall nominal return is just from inflation. So that's just the general rise in the in the prices of goods and services that accrue to the economy in general, and also to the owners of securities. The second component is the total payout yield. So one of the this is really the cash flows that come from investing from these securities. So for shareholders, this is the dividends that you earn. But what else is in there, of course, is buybacks. Because what they noted in this particular research paper is if you look back at the behavior of corporations in the last 20 and 30 years, there's actually quite a big change in behavior, particularly in US companies, whereby companies that actually had previously distributed most of the cash flows by dividends were actually buying back shares. from companies instead of paying dividends. So we actually saw dividend payout rates going down and buybacks were actually going up. So looking at that in aggregate as a mechanism of returning cash to shareholders gives you your total payout yield. And you can see that it's by far the largest component of the drivers of those returns. If you take out inflation, more than 2/3 of the return to stocks actually comes from dividends or share buybacks. And the final building block is the growth in those cash flows, or the growth in earnings per share. This is really productivity gains in corporations, the ability to actually produce things more effectively, more efficiently. In this particular case, earnings per share is a measure of corporate productivity, which you can really liken to, overall economic productivity as measured by, GDP per capita. If you aggregate those up, those three components, you can see that the fundamentals really account for about 8.8% of that nominal return of 9% that we've seen over that very, very long-term horizon. So in the long term, fundamentals are undoubtedly what drive share prices. In the short term, valuation matters, and it matters immensely. Daniel's going to talk about that. Over a 10 or even a 20-year period, it matters. In the long term, it's really these fundamental drivers that will decide what you can actually expect from share markets. These are the fundamentals that we focus on. If you can understand them and you can have reasonable expectations about what they may be in future, that can really set your expectations for how you want to invest in multi-asset portfolios. So that's where returns come from in the first place. I now wanted to turn to just some of the things that actually eat away or dilute those investor returns. And I wanted to start with implementation. So Burton Malkiel's an economist. He actually wrote a book called A Random Walk Down Wall Street. He's a very big proponent of keeping costs down in whatever format they might find themselves. Jack Bogle is also sort of widely quoted as, thinking about poor implementation as what he actually calls invisible costs. So things you don't actually see when you invest your money, but they're actually there. There was also a research paper that was done 2007. So the paper's a little dated, but it's nonetheless, I think the outcomes from this paper are still as relevant today as they were back then. And what this paper actually did was it sort of quantified the impact of trading on mutual funds. So it analyzed a little over 1,700 mutual funds. It took quarterly holdings data from Morningstar, as well as trading information from the New York Stock Exchange, as well as SEC filings. And what they attempted to do was actually quantify the impact or the costs of trading inside these mutual funds. And they basically broke it down into a number of different components. The first one was, commissions, the fees you actually pay to brokers for executing the trade. I think that's reasonably self-evident. There's, of course, the price impact, or the spread, I should say, which is the difference between the buy-sell spreads that you actually see on markets. So when you trade and you buy something, you have to then, if you wanted to sell it immediately, you have to find a seller. And typically there's a difference between where buyers and sellers are in the market. And that's the spread. That's the cost of investing. And then, of course, there's the price impact itself. And what the price impact is the difference in the price from the time or the moment you actually make a decision to buy or sell a security and the price that you actually realize. And what they did is they ran this analysis for large cap, for mid cap, and for small cap stocks. And you can see that those price impacts, it changes quite dramatically. When you get up to this, or you move into the small end of the market, the price impact can be a very significant part of your overall cost of actually trading. But focusing just perhaps on all stocks to start off with, when you look at the actual cost of trading within these funds over that period, it was a 10-year period, it's about 0.76%. Right? Now you think about 0.76%, what is that? That's the cost you actually have to make back just to get back to your initial starting capital amount. That's the cost of making the trade. If you didn't make the trade, you were 0.76 better off. As soon as you make the trade, you've now got to generate 0.76 to get back to your starting point. You compare that perhaps to the explicit management expense ratio that you might see from many funds. In many instances, that is as big or even larger than that. So focusing on these costs is super important, and understanding that they actually are in there or in these funds. Cost is only one aspect, so that was per unit cost. Of course, you've got to look at volume as well. So how much trading have you actually got? And here, in this particular case, this just overlays the actual, and this is not turnover, this is actual costs, right? So turnover is a relatively poor measure of the amount of trading activity. This looks at total purchases, total sales inside these funds. And you can see that on the right-hand axis here, these funds it's about 150 to 200% in terms of the volume that's actually incurred within these funds. And if you multiply that turnover by the per unit cost, you actually get the true cost of actually trading inside these funds. And again, what you can see with those costs is that they're very, very material, right? Being aware of them, understanding that they're there, striving to minimize them wherever possible is hugely important. And Andrew's going to talk a bit about how we think about implementation and trying to ensure that, that the good work that you do to generate those decent returns in the first place isn't actually undone by poor implementation. Another aspect, key aspect that tends to mean that investors get lower returns than the investments themselves is, of course, this issue of investor behavior, or the behavior gap. Now, Carl Richards is a financial planner. He writes in our Morningstar magazine. He's got a piece that he calls the behavior gap. I'm sure most people have actually heard of him. He draws these wonderful diagrams to sort of explain some really complex, I suppose, principles very, very easily. And he's noted this, that typically the studies find that the returns that, investors have earned over time are much lower than the returns of the average investment. And this is something that I showed this last year. I used a US example last year. This is actually an Australian equity fund. And what this actually shows you is that blue line is the performance of the fund itself, and the bars are actually the investor inflows and outflows from the fund. So this goes back, it's a 10-year period, and it just picks up, pre the GFC, behavior of investors pre the GFC, which you can see in those two very, positive green bars. That's investors investing strongly in the fund. The fund had positive performance and investors were following that. And what you actually saw is that through the GFC, when of course we saw markets start to plummet, investors reacted. Right? And we started to see outflows from the fund that basically have persisted ever since the GFC. So net investors have been sellers of the fund, despite the fact that at the absolute bottom of the GFC, the fund, of course, has recovered nearly all of its losses. And so what's the impact of that behavior from investors? If you look at the returns that the fund has actually reported over that period of time, it's 2.6% total return. That incorporates the big drop, on the way down pre-GFC. If you actually look at what the average investor has received from investing in that fund, this is the asset-weighted return. So taking into account those inflows and outflows, you can see that the average investor is in fact negative. So that's really the loss that you have from poor investor behavior. And that's really the loss that a financial planner acting as a behavioral coach to a client can really help mitigate. So you put all that together, hopefully help your investor keep the return, and then what really can come on top of that? And as Heather mentioned in the beginning, David Blanchette is our head of retirement research. In 2003, he and Paul Kaplan wrote an article called Alpha, Beta, and now Gamma. And really what they sought to quantify in this term that they called Gamma was the benefit from intelligent financial planning, right? So what's the additional return that a client can actually generate by using a financial planner and making intelligent financial planning decisions that otherwise they wouldn't actually earn or wouldn't accrue to them. And he tested, so this particular example, he looked at, it was retired people, age 65, male and female, and there's obviously certain base case assumptions that go into this, but he then tested a number of different factors and changed them based on somebody perhaps who doesn't have financial planning and somebody who did. And he sought to, as Heather said, quantify the impact of financial planning decisions on that base case scenario. So he looked at things like a total wealth approach, thinking carefully about somebody's human capital and not just their financial capital when you think about how you might invest their assets. One of the biggest things that came out of that was the ability to actually assess somebody or encourage somebody to invest on the basis of their risk capacity, how much risk they could actually take and how much they should be able to tolerate, rather than their risk preference, what they actually told you they wanted to invest in. So helping somebody invest on the basis of their capacity and less on their risk preference gave a pretty sizable incremental return. Liability relative optimization, thinking carefully about the return stream that an investor needed in retirement, thinking about their goals, and structuring the investments to actually meet that, again, was a source of additional value add. Product allocation or product location, thinking very carefully about different taxation structures. This is a US study, but it's as relevant, I think, in Australia. If you think about the differences in tax rates that individuals might have, compare that to, say, superannuation funds, to things like insurance bonds, they're very different tax structures and tax regimes that you can actually utilize, thinking carefully about which assets you want to put in which structures and how you actually sequence or where you take your withdrawals from makes a very big impact to the ultimate investor return. And savings and withdrawal guidance. This was a change, if you like, from the almost rule of thumb that had been applied up until that point in time, where somebody retired and you just gave them 4% of their finishing balance became their annual withdrawal rate, and you just inflation adjusted that over time. And there he looked at things like adjusting that withdrawal sequencing, if you like, every year, reviewing it on the basis of financial planning, what's actually happened to the portfolio, changing the rates to actually ensure portfolio survivability, and also looking at things like investor longevity changes. And again, that added an incremental return. In that particular research paper, he quantified that the additional, I suppose, what he called gamma, would be an additional 1.6% that was available to those investors per annum in retirement. Now that's just a number of things that he looked at. This paper's been updated. James will talk about that a little bit later. You'll see the numbers change. I don't think the numbers are actually that important. What I do think is important is that the number is big, right? And if you compare that number perhaps to the investment alpha that you'd be paying investment managers to generate, it's at least as large, if not larger. And importantly, it's not actually a zero-sum game. If you think about investment alpha, that is a zero-sum game. Well, in fact, after fees, it's actually a net negative game, because, of course, for somebody to win or generate alpha, somebody actually has to give it up. This particular source of advisor gamma is, it's not a zero-sum game. It's something that is actually available to every investor who actually uses a financial plan on the basis of making good financial planning decisions. So, in aggregate, that's what we think is super important to focus on. There's various components of generating those investor returns that I spoke about. One is, obviously capital market returns in the first place, and then thinking through very carefully around how we actually ensure that investors actually keep those. So thinking carefully about implementation shortfall and how we actually make sure that we don't dilute or denude the returns we've generated in the first place. Thinking about how we can actually work with everyone in this room on helping the behavior gap, or helping investors actually exhibit better investor behavior, and then really working in partnership to focus on these advisor gamma factors, which in aggregate really are the ways that we think we can work together to help generate better investor returns. So I'm going to leave it there, hand back to Heather, and might take any questions or comments if anyone has them.
Thank you, Chris. All right, so my colleagues will be here at the front with microphones. If you have a question for Chris before we move into the next session, just go ahead and raise your hand, and we'll bring the mic to you. And maybe as you're thinking of that, if you have a question, Chris, you started to expand on this at the end, but you talked in your presentation about the behavioral gap and that research that Carl Richards did, and then you were talking about the advisor gamma. And really there's a power of those really coming together and advisors adding additional value to help with that behavior. You want to expand perhaps a little bit on that? How those come together a bit more?
Yeah, I think the only thing I'd say is, when I sort of illustrate that chart that actually shows the various components and of course the advisor gamma, on top, I think perhaps just the one thing just to clarify is I think advisors have got a role to play in every single building block in that value chain. So selecting the right investment partner right up front, making sure that the returns get generated, being aware of what those funds or SMAs for those that are using them, being aware of what the implementation shortfall is within that. I think there's a lot of value that advisors can add to clients in understanding that and being on top of that. Likewise, I think being a behavioral coach, that's a massive value add that you only get, I think, through working with a financial planner. And then the advisor gamma is really, it's almost, it's a wonderful piece to have on top. But I think every single component of that, I would say, is largely attributable to having, a good advisor who's really acting as a fiduciary for their client.
Excellent. And we're going to talk, there's a question right here, so as the mic's coming from you, we're going to really dive deeper into that again in that last session about behavioral coaching and the important role that is in helping people really build and protect their wealth. So, yes, go ahead, question.
Okay. Chris, it's Lisa from InFocus here. Just want to ask if the fund, I understand you choose the performance and fundamental to actually set up the portfolio. And I want to understand if the market fall, what kind of protection method that you use when you set up those portfolio? Is it just by diversification or what kind of method that you're using inside?
So it's going to be a great speaker after me who's going to be able to answer that question. But I think very simply, diversification is undoubtedly, as I said, I think that's, from my perspective, that's almost a free lunch. If you can construct the portfolio correctly in the first place, you should hopefully have enough uncorrelated sources of return, and risk inside the portfolio. In fact, as Ray Dalio actually said, if you can find enough uncorrelated return sources and put them together inside a portfolio, you don't actually necessarily get a better investment return, but what you should actually have is a lower investment risk. That's actually something, he called it the holy grail of investing. So it wasn't about actually generating additional returns, it was more about underlying protection. So I think that's absolutely one aspect. And then I think the second aspect, which you're going to hear from both Daniel and Andrew on, is just the importance of cash inside a portfolio and the role that actually plays. Now, nobody loves cash. In fact, I think as a long-term asset, it's undoubtedly one of the worst ones that you can have. Generally, if you take it after tax and inflation, it doesn't help you, generate additional returns. So there's a very high measure that you want to place on actually holding cash inside a portfolio. But undoubtedly, that is a store of value that I don't think we should underestimate. And that's certainly something that we use, as I think those who've invested with us for a while will understand. We use that quite actively, not as a source of long-term returns, but certainly as a short-term source of portfolio diversification and capital preservation.
Great, thank you for that question. We'll take one more we have in the back.
Yeah, hi. Just a question about Advisor Gamma. Have you seen in your research the difference between an Advisor Gamma here in Australia compared to America or Asia and the advisors over there and what their Gamma makeup is?
So there hasn't been good research on it. David actually came, he was out here late last year, actually.
Yes, November.
Late last year. So he looked at, he looked at adjusting the research somewhat to account for, an Australian investor. But I don't think that there's a really good or seminal piece that we've done that looks at that. I would say also that, the numbers have changed quite dramatically. So when James comes up later on, you'll see that this was a 2013 paper that I showed you here. That's been updated. The numbers actually got bigger in the US. I expect the number is just as significant here, but no, the direct answer to your question is no, we don't have a particular paper out on the Australian-specific experience.
But that's a good idea for perhaps the next version of the research. So great. Well, would you please join me in thanking Chris? Thank you very much, Chris.